Hello.
Hi, Jack. How are you?
Doing well. How are you?
Good, good. So happy New Year.
Happy New Year.
How are things out there? Is it like stabilizing or is it getting worse?
Uh, I wish I knew. Yeah. Hopefully everyone else hops on soon.
Okay.
Michael, is Professor Zorro joining us today? Do we know?
Would you ask if he's coming?
Yeah.
I think he's
Oh,
coming.
he is.
Yep.
All right. Okay. Good morning, everyone, and good afternoon. We have a short presentation to talk about what we've done, what we've looked into, and where we want to go. So I guess we'll get started with that.
Thanks, Jack. Just one thing before you start, Hyman. I don't think if you met, I think you didn't meet Michael and Jack and Mike.
No, I didn't.
Yeah, I mean, our guest is joining us from India, actually. And as you could see, he's got the sweatshirt, the Quantinsti sweatshirt, right? Could you give us a quick, maybe 2-minute background so that these guys know who they're actually talking to?
Oh, yeah, sure. Thanks, Patrick. I was just about to stop Jack. So, first of all, a very happy New Year and a hello from India. And yeah, so just a brief background about myself. So, I'm working with Quantinsti. It's a pioneer or a leading institute in training people in algo and quant trading domain. And we have been in this industry for last 10 years, and we have different products and tools where we not only teach but also they give everyone the platform where they can apply the learnings from the course. And apart from that, we also have a high frequency trading firm, which is one of the leading volume generator in Indian exchange. And prior to joining Condensti, I've worked with Merrill Lynch and Barclays in their investment bank team, in the global markets team. And from the education side, I've done bachelor's in computer science and master's in finance. And very happy to meet you all in this 2021.
So Jack is gonna go through the presentation, but I guess the angle with you is basically, listen what they have to say, and because you're really on the technical side, also on the education side, maybe tell them, these are some of the things they could look into to further their aim. I guess that's the idea, because when we do projects, we like to have them. I mean, you have a great idea, but then it's not just doing that thing. It's really learn a little bit beyond, more techniques, maybe some books or courses or whatever you think is interesting. Jack, go right ahead. Sorry.
All right. Let me just share my screen.
You should be able to share that.
Yep. Let me just this, and you can all see this.
Yep.
All right. So this is our capstone update. Mike, you want to take this away? Mike. All right, I got this. So anyway, we took a step back to like figure out what we're trying to do. So we asked kind of three questions, and that's what are we investigating, why is it worth it, and then how do we model it, basically. This being such that when we actually develop whatever type of algorithm model, um, thought process on what we're doing, we know exactly what we're trying to do. So we kind of, with that in mind, we've kind of all taken separate ideas of like, okay, how can I look at a line and see how it means something, right? So um, that's kind of our big picture stuff. So just talking about lines for a second, like this is an example of lines. These would be spreads and over under lines for different games. This was on October 3rd of this year, where it's like you have a spread. So like if you look at the first game, it's Denver Tennessee, a spread at +6.5, -6.5. And then the odds are -110 on both sides, meaning $110 bet wins $100. I don't know if we need to go through the quoting entirely, but it obviously it helps to make sure we understand that. So, and then we have over unders as well. Originally, we were going to look at mispricings with money lines, and it's something we can definitely consider. But there's so many other markets within this that we have to consider a lot of different things. So just starting with the quoting. So we wanted to get into this and try and assign probabilities and understand what's happening. And since these are essentially binary derivative contracts, they can be very well modeled by a binomial tree, which obviously is something that's used in derivative pricing. So if you think about it, like a sports bet is a contract with two outcomes, which is binomial outcomes. So in this case, if you place a wager at -110, you either win $100 on a $110 wager, or you lose $110 wager. That's just a binomial tree. We should be able to price that. So for instance, if we look at a prop bet, specifically, we're going to look at the Aaron Rodgers passing yards prop bet from, I think this was 3 weeks ago. Just as an example, you can see that FanDuel quotes him over 293.5, an over under at 293.5 at -112, both sides. So it's an even distribution, with 293.5 being the middle. But then PointsBet quotes him at over under 300.5. But as you can see, that the odds are not symmetrical here. One side's +110, meaning $100 bet wins $110, and the other side's -161. So we can use this idea. We can use these binomial trees ideas and develop a probability distribution. And one thought we had is essentially constructing a butterfly type spread where we would hit, we'd have positions on both of these, and we'd be trying to capture that 293.5 yards to 300.5 yards, where we would actually pay out. And the other sides, it would just be perfect. It would be hedged such that there would be no loss if we were to put this in a trading strategy. This was just an idea, but to give us an idea of how we could do it, we consider the odds. And then based on these odds, we calculate a payout ratio. So essentially what this is if you put down your $112 times 1.89 would give you 212. Or if you put down your $100 at +110 times 210 would be 210. So $100 in, 210 out. Essentially the price of the asset is changing, if you will. We take these payout ratios and then we can calculate a risk neutral probability using present value factors as well. Again, all of this is from basic binomial tree pricing. And as you can see, we've developed a distribution, and the most important thing is the distribution does make some sense. There's a 50-50 split at 293.5, and then there's some portion of the distribution and then a point at 300.5, where 56% of it is underneath and 44% of it's above. So obviously we don't have something to show this on the slide, but essentially there's a 6%. We've derived that the market's saying there's a 6% chance that he throws between 293.5 and 300.5 yards. This was just like an idea we had. Going forward, these kind of, prop bet spreads are something we would like to look into, just because they're not going to be as liquid as some of the other, some other positions you could take, and illiquidity tends to lead to more alpha in terms of a strategy. So it was an idea. It's something we want to go into a little bit more. Need to obviously develop how the trading strategy would work. So I don't know if anyone else has anything else to share. That was a presentation. So
I can kind of explain our strategy going forward with along those lines. So basically, looking at that, we have that butterfly effect where we're looking at multiple sports books and we're trying to exploit differences between them. So what we're exploring is trying to find times when different sports books lines are wide enough that we get a large enough window in the middle to have a higher probability of hitting that middle where we double up our bet. And it's essentially risk-free, because if we don't hit the middle, we're only paying the premium that the sports book is asking for. So we've calculated that in order to make a profit off of the butterfly strategy, we need to hit the middle window where we would double up once every 15 tries, I believe, which is a pretty solid amount. And so now what we're doing is we're trying to scrape data in order to get a data set that we can explore how wide we need that window to be to hit it at least once every 15 times. And we're running into a bit of a bump with that, because these sports books don't want you to scrape their data. It's against their terms and conditions. So we're scraping it from a third party that scrapes it from the sports book. But it's not quite as reliable as scraping it directly from the sports book.
Yeah, so we're still trying to figure out a good strategy for collecting data in a really kind of complete way, in a continual way, because one aspect of it as well, looking at these point spreads, is that we see that the markets are hugely inefficient because the sports books will actually change their lines in order to encourage action on one side as well. So if our data collection and our algorithm that's analyzing this can pick up on some of those movements as well when the sports books will be furthest apart, that's something that we're trying to focus in on.
And then just one last thing to interject. So I know this was mentioned earlier, but so what the overall goal is right now in terms of what we're thinking of doing is essentially we're trying to explore any market inefficiencies. So we think the best way to do that is maybe to sort of steer clear of like some maybe higher profile games. And that's why so I don't know if you know, so money line means like the outcome of a game. So that's why we're thinking about steering clear of it, because if you kind of want to compare it to the Black-Scholes options pricing model, so you have one stochastic variable and what you're trying to do is squash any degree of randomness. But when you have the outcome of any sports game, you may have 4 or 5 stochastic variables. You have injuries, the weather. So that's why we're trying to maybe go towards player props, just because there's less factors in play.
Okay, so and then I'll let Ishan ask questions to see what his views are on this. So basically, instead of being more historically driven and model building, you are really you're skipping all that and you're going straight for an actual actionable endeavor here. You're literally looking at actual prices and I guess work the arbitrage and fix inefficiency. So right. So this is not a academic exercise, right? Where you could see, well, this was a historical relationship, and this is what we've noticed. You're more focused on what's actually going on with some real prices today. I mean, the end result is going to be, this is where we would use, right? You're building a model to take advantage of this situation, the same way you would do in a hedge fund for whatever.
Yeah, essentially trying to develop a trading type algorithm type
Okay.
thing.
Ishan?
It does sound pretty good, but I think a couple of questions from a realistic perspective. So, have you tried to even place a smaller orders, seeing this arbitrage, like to see actually whether this arbitrage really exists, or is it just on paper, this trades which you just showed?
I think that's where we get into like we need to have our data collection figured out. Because in that case, I mean, I'd say like, yeah, that arbitrage does exist because you can hedge on both sides and minimize your losses if it weren't to hit in that range, the specific range that I gave. We have to actually like develop it and see if that's just like a one-time thing or if that's actually happening. I mean, we've definitely looked through this and we've definitely seen some wide quote differences. And as you can get into like, there's a lot of like theoretical things you could look at to say that this exists. For instance, like obviously sports books are a regional thing. So like if you go to a different region, you might get a different quote because there might be different biases from fans. So something to consider. Don't know how that would work in the practicality aspect, but like that's where we have to really get into we have to develop our data collection a little bit better because we need to be able to point out, oh, this does exist. This is how frequently these happen. And these are positions you could take to profit on them. So,
Okay. So
yeah.
I think while you're doing data collection, I think a couple of things to note for is when you're collecting data, you have to make sure whether that's the quote at which someone is ready to take your bid, or it is the last traded price or the last bid at which someone executed the order, right? Because that assumption will have a drastic impact on the P&L or the orders at which you'll be executing, right? And so, for example, even if you go at the granular level, let's say at 10 a.m., what's the quote? But if that is a stale quote, it will not help you much in modeling the right thing for you. And second is also in terms of the counterparty risk, which you can consider because you'll be dealing with the brokers. So the brokers which you mentioned are assuming are the high profile brokers, so they won't default. But if you go very low, in the sense regional brokers, which you are just talking about, they might not be very stringent in the sense, let's assume this goes very well, and you decided to deploy, say, millions of dollars in this strategy, right? So that's where this will also come into the picture, whether the broker is liquid enough, strong enough to actually either give you the payments when it becomes due. So the credit risk, this thing, and third is I think that we can talk later on. But yeah, these are the two things from my side.
Gotcha. My understanding is that they're currently quoted prices when you're looking at a sports book. I think Mike has a little bit more experience with this, and maybe he can talk about it a little bit. My understanding is if they quote a price and you take it, they have to take it. Right, Mike?
Are you saying in terms of what the book is profiting off of?
No, like what the book's quoting. Like if they quote over under 42.5 at odds -110 to both sides, they have to take it if you take that position, right? Like there's no like last minute shift or last second shift, if you will, because you take
Yeah,
it.
once you what if you take however many units, once you lock that in, even if there's any price movement or odd movement, then it locks in whatever you said.
Right.
Okay, and Mike, is there some kind of a minimum capital which is required to enter into bid, or is it like any
It could be,
dollar amount you can take?
yeah, so on a lot of legal sports books, it could actually be like 10 cents, 25 cents. And I think there might be a maximum unit. I want to say it's around 10,000 or 15,000. But I'm not positive about that. But the minimum can be as low as you want, and the maximum is also quite high.
Okay, so that sounds good because you have to hedge the book perfectly, right?
Right.
From one broker to other. So you have to make sure the ceiling is not broken. But I think what you're saying is should not be a problem because the low can be anything. So yeah. Yeah, sounds pretty interesting, but I'll be more convinced if you actually taken one of the trades in this brokers and share your experience of how it went about.
Right. I feel like once we actually develop a prototype and have at least a small sample size that we can test it against, it's going to be way more helpful for us moving forward, especially
Yep.
talking to you as well.
Any techniques or any systems or language or Ishan, do you think they should be using to help them scrape the data and
So this unofficially people use Beautiful Soup in Python for scraping the website data, but you also have to check with the website whether it is legal to scrape the data. So tools per se you can use that, but you should also get the permission from the website. If they explicitly mention you should not scrape my website. That's what someone told in the presentation. And from models perspective, so this is a pure arbitrage, right? So someone is like you are getting something at 100 and selling at 110 and making a pure arbitrage of $10, right? So as such, there is no modeling requirement in this, right? It's just you have to do a back testing whether it works or not. And I think someone mentioned about binary options and all those. I think those are not required per se because you see a price difference. You buy at one place and sell at the other place and make the spread from it. So this is a very straightforward project which does not require any kind of a complexity. But at the same time, you have to be very aware of what kind of data you are putting in and whether it is practically possible or not.
so what's the next step, guys?
Really dive into the Python and try and create a data set, I guess would be the next step. We we've looked at a couple of data providers. I think Mike looked into specifically a data provider called the Action Network, which is a bit of it's a paid subscription, but they had a pretty nice deal going a few days ago. So we're going to take a look into that and see what tools that they have to use, because they can quote all the books at once and have a bunch of tools that they can use that they offer. We'll also take a look. Actually, I took a shot at Beautiful Soup, trying to pull things from a different site that didn't say anything about don't scrape this. So we'll have to take another shot at it. It's been an interesting it's been an interesting experience, but there's definitely been some success there. So trying to essentially just develop a data set, and then we'll be able to look at these things change, because you can't really look at a historical price, if you will. So the back testing doesn't really work without having that. So yeah.
So once you have, let's say you come up with something, then you'll be able to live test it. Meaning, you could, how do you know you're correct or not? Or you're going to build something and then you're going to test it on the, with not actually trading, but you're going to see the prices and you're going to see what if we had done it, then we would have been right or we would have been wrong. Is that the end result here?
Yeah, looking at we actually kind of tried to do this, I think last week. We tracked a couple of lines that we liked the spreads that they had, and or just like, if we took this position, how would this work? Kind of thing. That's kind of how it works. Like I was, just looking for, like, would this thing work? Would this strategy work? Would this strategy not work? And try and further develop that. And then
That's interesting. So you're doing it going forward as opposed. Okay, great. I mean, we have, no rush for now. I mean, we got plenty of time. You guys have plenty of time to develop the thinking. And Ishan, let us know if you could think of anything that they should be looking at, a book or anything of that nature. I know you do a lot of algo trading, so.
Yeah, I think they are on the right track. So I think I'll be very keen to see the experiences which you do while doing live trading. It can be on the small amount, but I think that is what differentiates academic project from the live project, right? So you're actually dealing with something and sharing your experience based on that. So there is a proof of concept to whatever you're doing through that. So I think that is the
Well,
key.
they're not going to actually spend real money on this. They're just going to,
Okay.
right?
But
I mean,
we can have a very small amount, right? Because someone said like you can also deal in cents, right? So a very small token amount, like just to see things are working.
That's
If
something.
allowed by the university.
Yeah, I know. I don't want to promote gambling here. Take it easy. Just want to be clear. Okay, guys, that's fine. Anything else we should talk about? Otherwise, we're good to go. Ishan, thanks for joining us. We'll meet you in a month to see what kind of progress we've made.
Yep, and thank you everyone.
Okay.
Thank you.
Thank you.
Thank you.
Ishan. Bye-bye.
Take care.
yeah.
Okay.